Well, good afternoon, everyone. It is 12 o'clock Central Time. It is Wednesday. It is Wednesdays with Wayne. This is the first Wednesdays with Wayne of 2023. And as always, I want to thank you so much for taking time out of your day today to join us. We're going to start the year off with a market update because I really feel like for a lot of us, let me back up for a second. For those of you that this is not your first one, this is Wayne. Thanks for coming back for another year. For those of you that are, welcome. We had quite a few people decide to subscribe at the end of the year, so we want to welcome you guys. Those of you that have been through this before, you know how it goes. We're going to be on here for about an hour, maybe a little bit longer today, and then we'll do a Q&A at the end. So if you have questions, you can wait till the end, or as always, if you have a question, raise your hand and Maddie will let you in. Thank you for attending. I just got a text from my co-presenter here. Okay. 2023 market update, what I'm calling the year of the pro. A lot of people have been calling it that. This is going to be a defining year in real estate, in my opinion. And my goal, our goal at Cedar Field Consulting is to help our people be able to navigate this marketplace regardless of what it does. And so we're going to talk about the issues that are going on in real estate. And I'm going to give you some strategies that I think are extremely important in the first quarter of this year, and I'll lay out why statistically and all of those things. So let's get started. Let's go through the market update for 2023, tell you guys what to expect, how to position yourself properly in the market for where we think it's going. And we are going to start with the number one issue currently shaping the real estate market, and that's going to be interest rates. And we have a special guest today by the name of Bo Bellman, or Bowen Belmer. Bo, thanks so much for coming. I really do appreciate you being here.
Yeah, absolutely, Wayne. I really appreciate you and the whole Cedar Field team for having me on. So just as a quick introduction for anybody listening, my name's Bowen Belmer. I'm a loan officer with Summit Financial LLC. I'm also the host of the Opportunity Cost podcast, and I write a daily economic research newsletter called The Homepage. So, Wayne, if we can flip to the next one.
Wait a minute, I want to tell you guys how I met Bo. So I did an event in Milwaukee a couple of months ago, and Bo was one of the sponsors. His company was one of the sponsors. And so Bo gave about a 10-minute presentation on interest rates and where we were and why. And after hearing him, I reached out to him and said, I need you to talk to my brokerage clients. And then, because it was absolutely, and he's on here, so don't blush when I say this, it was one of the most eloquent, easy for me to understand presentations on where we are and why. And I think it's really important, guys, moving forward in 2023, that you be able to speak to the why we are where we are, as opposed to just going, yeah, it's where we are, I don't know when it's going to change. So I wanted Bo to come on and give you guys a little bit of a history lesson on interest rates, and more importantly, where we're going and what to expect. So Bo, with that opening, I will click to your next slide and take it away, my friend.
Awesome. Thanks, Wayne. So as I kind of dive into this, I want everyone to know, first of all, this stuff is intuitive for nobody. Nobody looks at this stuff the first time and instantly understands what they're looking at, which is part of the reason that I really enjoy doing this type of research. And I also want to invite every single one of you to absolutely plagiarize me as much as possible. If I say something or you read something that you enjoy, get that snip tool out on your desktop and snag a picture of it. And you do not even need to cite me as a source. I really don't mind. I genuinely do this because I enjoy it, and also because I really think it's valuable for you and your clients to understand not just what's happening, but why it's happening, and how we can kind of use that to forecast what things might look like in the future. At the end of this, I'm also going to do what probably no other MLO is going to do, and I'm going to give you hard numbers on where I think mortgage rates are going to be at the end of each quarter of 23. The reason being, I am confident in my reason for thinking what I think, and also if I'm wrong, you're not going to remember probably anyway. So we'll keep rolling forward. So like Wayne said, where are we right now? Understanding that is kind of the key to looking at where we're going moving forward. we all know, anybody who's in the market in 2022 knows that it was a crazy year. Without looking at some of this mapped out, it's kind of hard to understand just how crazy it was. So as a little bit of a recap, we saw 7 federal fund rate hikes in 2022. 4 of them were 75 basis points, meaning 0.75%. And each one of those was 3 times the size of the standard rate hike that historically would be put in place, which is 25 basis points. So when we see like this vertical growth in 2022 on the federal funds rate, and we see it really mapped out, the only time period in the last 20 years that even comes close is the global heading basically into the global financial crisis, pre-2008. Now, as a quick refresher for everybody, the federal funds rate is the rate that banks pay each other or charge each other in order to meet their daily reserve requirement. So as you may or may not know, when you go and deposit $1 into your bank account, that is no longer your dollar. That is now the bank's dollar. Your dollar is effectively an IOU, so that when you go to withdraw it someday, hopefully they still have that dollar to give you back. Now, because of many lessons in history, the biggest one being the bank run leading to the Great Depression in the 20s or following the 20s, banks now have to meet what's called a reserve requirement. This is a certain percentage of dollars that they must have on hand at the end of every single day. Now, if a bank is under that requirement, they must borrow funds from another bank in order to meet their requirement. If a bank is over that requirement, they can lend to another bank. When we talk about the federal funds rate, that is the rate of interest that they are paying or charging in order to do that on a daily basis. It impacts many parts of the economy, not just mortgage rates, not just interest rates in general. It really is one of the most widespread factors in what the macro economy looks like, because banks' ability to borrow more money is going to directly impact the ability for anybody else, including you as a consumer, institutions, and anyone else's ability to borrow money, and how much access to that capital they have. So looking at where we are right now, the federal funds rate today is about 4.33%. It's technically slightly floating, so that was a number from yesterday, but it's approximately true. The Fed is planning on getting that rate into the range of 5 to 7%. Now, depending on which Fed member you listen to, you're going to get a different answer. The most frequently quoted number is somewhere between 5.25% and 5.5%. So that's where this red range is right here that you're looking at in that box. That would imply 75 basis points more of hikes at least. Those will probably not be done all at once. Those will most likely be done in succession from one another, whether that be 3 25 basis point hikes, maybe 150 basis point with 125. That part, unfortunately, nobody but the Fed has the answer to that. Looking below, though, let's look at inflation. Let's remember that when the Fed's hiking rates, they're doing this for, well, really one reason. They're either hiking rates to try to slow down the economy, or they're cutting rates to try to speed up the economy. Right now, they're trying to slow things down as much as possible without sending us into like a tailspin recession, because inflation got so out of control that they need to fight it. Well, as we can see here on this lower graph, or lower bar chart rather, that black dotted line, that is your 3-month moving average, which is basically a quarterly moving average. We see a very distinct slope begin in June of 22, which right now implies that we have seen the peak of what inflation is going to hit in this cycle. For all of our sakes, we hope that is true for multiple reasons. The biggest one being the sooner that figure moves down towards that red line, which is their target rate, the sooner we're going to see interest rate cuts, and we will start to see access to capital become a lot easier, which will trickle down and include mortgage rates. Can we flip to the next one? Thank you, Wayne. So what I want to show you today is what the future might look like according to what the Fed says versus what the future might look like according to what the Fed has historically done. Now, I'm not one for political statements, but I think we all know that, the Fed is maybe not the most reliable source of all time if we only listen to what they say they're going to do as opposed to what they've actually done in practice. And so if we just look at what the Fed's saying, they're targeting a rate between 5 and 7%. Like I had said, the most frequently quoted figures are about 5.25 to 5.5. Jerome Powell, the Fed chair, who has arguably the worst job in the world, and that is a job that I would never, ever want, is really, really sticking to his guns on the idea that they are going to continue making capital more expensive until they see inflation get down to that 2% level, no matter what it takes, even if that means not having any type of rate cut until 2024 or beyond. So what this graph here is highlighting is that move upward to basically that 5.25 to 5.5 range, and then flat to no movement until 2024 or beyond, where they would anticipate potentially starting to cut rates. The reason that he is being so stern on wanting to hold this level is because a worst case scenario would be they decide to cut rates too early, inflation kind of rebounds and continues on, and now we're in a worse position than we were before because the economy was sent into, depending on who you ask, a recession or pseudo recession, and it didn't work. We basically were sent into a recession for no reason, only then to have inflation come roaring back. Inflation is historically very hard to battle, especially over a long period of time, which is why in news headlines or on different talk shows and stuff, you'll see people refer to it as sticky. They're referring to it literally being sticky as in like hard to get rid of, hard to get off of, like if you have something sticky on your hand. So in general, according to their words, they're indicating they will not be cutting rates in 2023. Wayne, can we flip to the next one? But history tells us a different story, and what their actions have been over the past basically 30 years has been a completely different story. The median time frame between the terminal rate, meaning the highest peak of the federal funds rate, to their first rate cut has been approximately 8 months, with an average of 11 months. That would imply that if we see that terminal rate in March of 2023, which is the timeline that I believe we're going to see, we will actually see the first rate cut in about November of 23. And that is strictly based off of history and data, not really listening to the posturing that I believe the Fed is currently doing. The cumulative rate cut is likely to be approximately 2.25% from the peak. Again, that's derived from a median of historical data. I love using medians and not averages. There's an excellent book called The Flaw of Averages that I recommend everybody read if you're interested in math and data in general, because they can be skewed much more easily than medians can. This chart, or I'm sorry, this box below kind of breaks down the other cycles and where this data is coming from. Wayne, if we can flip to the next one, please. So we have the Fed saying one thing, we have history telling us something different. What is the market saying? Because ultimately, the market and its participants are going to drive what everything else ends up looking like. Turns out, as of right now, the market is agreeing with historical data, and they're not agreeing with what the Fed is saying via their comments. And in fact, it's actually being more aggressive than what the historical data would tell you just by reading it on a page. So the market right now is pricing in a peak. So that's the blue line right there with the red circle. It's pricing in a peak federal funds rate in about May and June. So slightly later than I'm anticipating, but also a slightly lower peak of about 5%. And it's pricing in the first 25 basis point rate hike in November, which is approximately right on line with the timeline I just laid out using historical data. So basically the market is saying, hey, we believe that the median of what we've seen over time is going to repeat itself. If you look at the money markets, so specifically the Euro US dollar traders who are trading futures of the Euro US dollar, they're pricing in 200 basis points of cuts before the first one even happens. So the reason that's significant is because I told you just previously that history would tell us from peak to trough, we're probably going to see about 2.25 in total cuts cumulative. And that might take, a year. That might take 2 years. That might not be till 25 till that actually we hit that trough. But the market today is pricing in 2.12% of cuts before we've even seen the first one, which implies the market being very, very aggressive. And they believe that these cuts are going to come quick and they're going to come basically extremely high in magnitude. And so again, really going against what Jerome Powell and the Fed are kind of saying they're planning on doing. We can flip to the next one quick, Wayne. So something I wanted to touch on is the kind of one of the mortgage indicators that mortgage rate indicators that you probably don't hear a lot about. You certainly working in this industry hear about the federal funds rate all the time. What you might not know is that the federal funds rate is not even close to the most correlated asset, or asset's a strong word. You can't buy the federal funds rate, but it's not even close to the most correlated metric to the 30-year fixed rate mortgage. That title actually goes to the 10-year treasury. And so this graph below is showing us the 10-year treasury compared to the 30-year fixed rate mortgages. And as you can see, they move almost directly in line with one another. So why is that? Well, the first thing to understand is what is a treasury? So a treasury is a bond that is issued by the US government. It is effectively the US government saying, hey, if you lend us some money, we will pay you interest for it, and we will go do all of our government spending and other things with that money that you lent us. And we are guaranteeing this interest rate with the full faith of the US government. And so in general, treasuries are considered to be very safe investments because in theory, the only way you don't get paid back is if the US government were to fold or have some type of major issue where they couldn't pay you back. The 10-year treasury is often looked at as the risk-free benchmark because it is the US government saying we will pay you back over the next 10 years, and this is the rate that we think we can do that at. And 10 years is usually a long enough time horizon to get through any type of market turmoil that you might be facing. So another thing to understand before I kind of dive into this a little bit further is that bonds have an inverse relationship between price and yield. And that is like the key point on this slide to understand. The more expensive a bond is, meaning the more people who are buying it and giving the government money. So 10-year treasury, the more people that are giving money to the 10-year treasury, the less interest the US government will pay for the people coming after them. The fewer people who are willing to give them money and lend them money for that interest, the more they will pay you in interest because they need cash. They are going to try to drive more demand so that they can have more cash. So the people who are willing to do it are going to get paid more for it. Why does that relate at all to mortgages? Well, mortgage rates are very closely correlated to mortgage-backed securities as well, which are also bonds. But mortgage-backed securities are looked at as more risky than treasuries are because mortgage-backed securities are backed by what is looked at as the safest retail asset in the country, being homes and mortgages, but treasuries are backed by the full faith of the US government. So you know that mortgage-backed securities are always going to trade at a premium to treasuries because they are looked at as more risky. But if we look at the average duration of a 30-year fixed mortgage, it's 7 years, meaning on any mortgage that's issued 30-year fixed, the market is anticipating that mortgage to only be outstanding for about 7 years, whether that be through payoff or default, which is the closest we get to 10 years on a treasury scale, right? 7 years on a mortgage, 10 years on a treasury. So they're easily comparable. So if somebody's going to buy a fixed rate asset, they're going to lend money to somebody in order to get paid interest. They're often going to be choosing between mortgage-backed securities and the 10-year treasury. Because of that, they float back and forth between the two. And so the price of one is going to dictate the demand for the other. And I know that that was a lot of information. So I have no expectation that people are going to completely understand that whole explanation at one time. The really key thing here, and sorry, Wayne, I'll move on. Just one more thing is that
I hit the wrong button. My apologies.
No worries. Is the spread between the 10-year treasury and 30-year fixed rate mortgage historically is about 2%. So if you see an aggressive move on 10-year treasuries on any given day or week, you can essentially add 2%, and that's about what you can expect for mortgages. And that works in the inverse as well. As one moves, you can anticipate how the other one is likely to move. And the market's pretty efficient, so it happens pretty quickly, but it's not immediate. You know, it's not like in the same 3 minutes, both are moving completely in succession with one another. So when I'm looking to lock somebody, for example, I do pay attention to the 10-year, because if it's made an aggressive move, let's say in the morning, by the afternoon, I'm likely to see mortgages move in a similar direction because of that. So now I want to go to some good news and some things we can look forward to, and then I will give kind of my projections on how all of this is actually likely to impact mortgages this year. So on to the next one, Wayne. So the good news is, and you're going to be asked that golden question by all of your clients, is it a good time to buy a home? Well, there's two ways to answer this question. If it's a first-time home buyer, the answer is always yes, because if you're renting, you're not building equity on anything. And so building equity on something, even if you're paying more for it, is better than building equity on nothing. Where it gets more complicated is for your buyers who already own a home and might be changing their living situation, and they're unsure if they want to give up their current financing situation to jump into a new one. For them, of course, the answer is always, it depends. But it only depends to a certain point. So this chart I'm showing you below that I made is highlighting the fact that if you look at the median home sales price in the United States, there have only been 3 years in three 5-year periods in the last 20 years where you could buy the median home and sell it for a loss 5 years later. And that was 2005, 6, and 7, leading up to the global financial crisis. In fact, those 3 years over the past 52 years are the only time that you could buy the median home in the United States and sell it for a loss 5 years later. Further, there has never been a 7-year stretch in the United States where you could buy the median home and sell it for a loss 7 years later. So when I say it depends, if I'm talking to a buyer and I know that they're not going to move for 5 years, it's a pretty safe bet, especially around that median price point. If I know that they're not going to move for 7 years, I can with almost full certainty tell them you will not lose a dollar on this home. Of course, this is based on the median price point. So case by case basis, but that's a really powerful statement. So in some cases, the answer to, is it a good time to buy a home from a mortgage perspective, is it doesn't matter, because you can refinance it later. And if you're planning on living in this home for any significant period of time, history tells us that you're going to be in good shape. You just have to weather the storm in the meantime. As far as projection goes for where mortgages are actually going to be, my hard numbers, and feel free to write these down and tell me if I'm wrong, are I believe we have not yet seen the peak of where they're going to get. We have seen a pullback towards the end of this year based on everything that's happening and the fact that we know that capital from the federal funds rate perspective is going to get more expensive in 2023. I do not think we've seen the top of the market yet for mortgages. I'm expecting to see something in the context of 7.5 to 7.75% right around the end of Q1 2023. With that being said, we're likely to see inflation be continually curbed as it has been. Because of that, the Fed at some point is going to have to make a pretty harsh switch to either stop rising rates altogether or begin those rate cuts. I believe that's going to happen towards the end of Q2. And around that time, we will probably be in a similar position to where we are exactly today. So let's say the context of 6.5%. That is likely to continue on into Q3, where we will continue to see things decline, probably into the context of 6 to 6.25. I believe that we will end next year, end of Q4, in the context of 5.75%, because that is when we're going to see that first rate cut right around November. Again, I am not a fortune teller. This is just my opinion. And I cannot legally tell you that this is a certainty, nor would I want to, but I'm happy to give you a real and honest projection based on data and fact as to where I believe it's going to be. And I think most people are afraid to do that for whatever reason, but I'm happy to do it for you.
All right, Bo. Here's some context. Oh, go ahead. Sorry.
Oh, it looks like we've got a question, but Wayne, if you'd like to continue first.
Well, I was just going to say, guys, here is Bowen's contact info. You should follow the guy on Instagram. You should listen to his podcast. You should get the homepage emails every day. Bo, thank you so much. I really appreciate the insight.
I guess anybody who is, sorry, Wayne.
No, go ahead.
I was just going to say, anybody who is interested in being in touch, I am more than happy to talk to people, one-on-one as well. So definitely feel free to reach out if you do have any questions or just want more clarity on any of the stuff that I spoke about. I'll make sure that these slides get shared with you as well, because like I said, please plagiarize me. I create this content to be plagiarized, and I really do mean that. And also that QR code right at the bottom there is all the information and more that you could ever want about me, probably more. So if you're looking to get in touch, just scan that code and you'll find everything you're looking for. So thank you again.
All right, perfect. So Maddie, we have a question.
Yes. Jennifer, I'm going to give you permission to speak if you'd like to unmute yourself. You're welcome to ask your question.
Okay. Hi. Can you guys hear me?
We can.
You betcha.
Okay. Hi. Happy New Year, everybody. Thank you, Wayne. And it's nice to meet you as well, Bowen. So you mentioned about buyers that if they're renters, obviously now is a good time. And then obviously if they're going to stay in a home 5 to 7 years, you feel like it's a safe bet based on just the historical median home values in the United States. So how do you feel about buyers that say, I'm probably going to get relocated in another 2 years, or somebody that's looking that they're going to be making a move in less than 5 years?
Sure. Is it so? I hate doing this to you, but of course the answer is always it depends. But if they are, Wayne's cracking up. But if they're a first-time home buyer, I do stand by that notion that it is always a good time to buy. And I make this comment to a lot of people. If you do not own yet, you basically have you have three choices basically as to where you can live. You can pay someone else's mortgage, which is essentially you renting. You can live with mom and dad, or you can pick up your mortgage. I just thought of a fourth one. You can go to jail. So you have four places on where you can live essentially. And if you're paying someone else's mortgage, you're basically doing yourself no favors for your financial future. So as far as first-time home buyers go, I'm always on the camp of owning something is better than owning nothing. If it's somebody in a more complicated situation, like they're looking to buy and they already own, my advice to them would be be very strategic about what price point you buy at, because in different locations, different price points are going to have completely different markets. So for example, up here in Wisconsin, the median home value is $265,000.
Wow.
That means that if you were purchasing a home in, let's call it the 650 and above range, your odds of losing money in the short term due to market volatility are a lot higher, simply because there are not as many buyers who are in that segment of the market. And so if it were me and I knew I'm going to be living somewhere for a short period of time, I would maybe choose to live in a place that's more affordable than maybe my forever home would be, in order to stay in a segment of the market that's very highly populated, so that when I do go to sell, there's tons of people itching to buy at that price point. Does that make sense?
Yeah, that's perfect. That's a great response. I love that. Yeah, that
Hey,
it's still a good
Jennifer,
idea to buy, but just maybe buy down and be strategic about that.
Yeah, I mean, people have to treat it like any other asset. I think people look at their home they look at their home and mortgage as a liability, but it's an asset. It is the most powerful tool you have. So you need to be discerning, not just based off of, do you like the home and area and location or not, but do you like the profile of this investable asset that you have just purchased? You kind of need both sides.
Great. Thank you.
Hey, Jennifer, I might be able to add something to that as well. So here in good old Springfield, Missouri, I remember having this conversation years ago when I was selling, and people would come to town and they would say, I'm transferred into town. And my first question was always, how long are you going to be here? And they would say, I'm going to be transferred again in 2 years. And I would look at them and say, your best financial option, honestly, is to rent, because we had 1.5% appreciation year over year. We had a marketplace that never was too high, it never was too low. We just rocked along at 1.5%. And to mirror what Bo said, it does depend. I think it would be interesting to do a historical average of appreciation, or the median appreciation, I guess I should say, Bo, for your marketplace, to give you a little bit of a better, more discerning answer for people. Because there was a time in our market that you were going to lose money in a 2-year time frame, unless your corporation was paying all of your commissions and your fees. If you had to pay expenses on the back on when you left or when you sold, you were going to lose money. So that might be I think it is local, the local issue.
Okay, great. Thank you.
I hope that helps. All right, Bo is going to hang around. He's promised me he'll hang around till the end. So if you have any more questions for Bowen, he'll be happy to answer them. Let me go into some other issues that I think are currently shaping our market, and more importantly, some action steps that I'm most definitely going to recommend that you take in the first quarter of this year. And I don't mean to beat you guys over the head with this, but the NAR class action lawsuit, that if you've been on Wednesdays with Wayne last year, you heard me mention this. If you're brand new, you may not have ever even heard of this. There is a class action lawsuit against the National Association of Realtors, as well as basically all of the major brands, regarding buyer agent fees. There was just an article that came out last week that the projected trial date is late 2023. What does that even mean? What does that even matter? Basically, and we're going to do sessions on this, so we're going to provide you with the information. I think everybody needs to really solidly look at really working hard in the first part of this year on a buyer presentation, because it could come down that you're going to have a buyer agency signed, with a fee already agreed to before you're going to be able to start the process of showing property. I just wanted to let you, because we've been mentioning this throughout the last year. I just wanted to let you guys know one of the major brands asked for a longer time period. NAR fought it. The judge granted it. So they're projecting late 2023 for it to go to trial if they don't get it settled out before then. I do believe, guys, really, really seriously, you need to upgrade. Most of us, the vast majority of us, need to upgrade our buyer presentation skills to show a buyer what they get when they hire you. Okay. We will be addressing this again. If you want to go back through, we did a session on it last year with a role play and all of those things. If you want to go back and access the recordings from last year, feel free. But I think this is going to be a big deal. Here's the other big news that has just recently happened. The national agent count is dropping. We have had an explosion in agent count for the last 10 years. There are 58% more realtors in the marketplace at the end of 22 than were in the marketplace at the end of 2012. There's the percentage increase per year. So as all of us know, we have been adding agents at a record pace. All right. Warren Buffett said, you'll only learn who's been swimming naked when the tide goes out. Well, here's the first shoe to drop. In 2021, NAR added an average of 8,400 people a month. Now, this is a net gain, guys. So in 2021, every month, we had 8,400 more realtors nationally than we had the month before. This is not the number of people who joined NAR. This also factors in the number of people who left NAR. So these are net numbers. Through November of 22, the average was 4,134 people a month, okay, for 2022. In December, this just came out a couple of days ago. In December, the agent count dropped by 17,146 people nationwide. The largest one-month drop since December of 2009, which was what? That was the great economic crash of 2008 and 9. So if you are of the mindset that there's certainly a lot of realtors, and some people would make the case there's too many realtors. This is the first thing that we've happened. I think that we're going to see this trend continue because I think a lot of people got in. We know a lot of people got in, and a lot of people are just suffering from whiplash, meaning 2021, if you're a broker or either if you're an agent that was in the market in 2021, we were having to invent on the fly new strategies to navigate the marketplace that we were in. And they actually were reactive strategies, meaning we had to come up with how do I present 17 offers to a seller, 15 of which are cash, and they're all over full price. I need a spreadsheet or something, right? And we had this unbelievable marketplace that we operated in. And everything that brokers we were doing and that I was doing with agents was how do you navigate all this voluminous activity you have going on? Tail end of 2022, now to January of 23, there's things we need to learn, but it's the opposite of what we needed to learn. We now need to not worry about having to help a seller navigate through 17 cash offers that are over full price. We need to learn the skill set of how to talk to our seller about the offer they have that is perhaps less than they wanted to take, but is a number that they should look seriously at because it's the only offer that they have. And being able to navigate our way through the showing feedback and all of those things, which those old school of us that have been around as long as I have, it's back to more of a normal type market. So I think the real whiplash, honestly, is for the agents that might have gotten in the business late 19, 20, perhaps early 21, because the marketplace that we were in, A, was unsustainable, and B, wasn't really realistic. It was just an interesting bubble in the market. But the problem is that frames how we look at today's market, as well as it frames how a buyer looks at today's market. 91% of the members of NAR have not sold property in a market where interest rates are over 4% and days on market are over 45 days. So this is just as new a territory as 2021 was. I just pulled this up this morning. Here's NAR's numbers for November of 2022. We are on pace, and they won't have it until next month. We are on pace for 4.09 million sales. Remember, 1,580,000 realtors. So you can do your own math there on the average number of sales per agent. Month over month, went down 7% in the number of sales. Year over year, we're off 35% in the numbers of transactions. Inventory is at 3.3 months right now. We were at 2.1 months a year ago. What does that mean? That means that our communication strategies and our protocols with sellers become even more important the longer we're on the market. And we see that prices continue to rise. We're up 3.5%. All right. This is why this is the year. For a lot of people, this is kind of the marketplace that you've been waiting for because you have everything dialed in and you're ready. And I've had some clients that have said, I'm so ready for this marketplace because we've got the right things in place. What I call the immutable laws are back in play. And I want to lay out 3 of these for you. And then we're going to cover all of the immutable laws of real estate in our next session because it is the way that the marketplace works, the way year over year the marketplace works. But here's 3 of the big ones. Law number 10 is the payment law. And it says that most buyers really don't care about the final sales price of the home they purchase. They only care about their down payment and their monthly payment. This to Bowen's point earlier, if you're renting, even at a 6.5% interest rate, your payment's going to be less than what you're paying in rent right now. We now live, my opinion, in a payment-driven economy. Everything is driven by how much your monthly payment is going to be. Everything is driven by what it's going to cost me to go borrow money to have the things that I want, whether it's a house, whether it's a car. If you go on Amazon, they give you a payment option for anything that you want to buy. We're a payment-driven economy. That plays into the marketplace in and of itself, in tandem with the other rules. Law number 14 is expectation. All of a sudden, now we're back to where the condition of a home needs to be at the market. Remember 2021? It didn't matter if there was a hole in the wall. It didn't matter if the carpets were stained and torn up. It didn't matter if the appliances were worn out. There was such a fever pitch and so much cash. Isn't it weird how in 2021, you would have multiple cash offers, and now all of a sudden we're all worried about interest rates. Where'd all the cash go, right? So the condition of a home needs to be at the market. Buyers will not pay extra money for things they do not expect. I'll go into that in detail in 2 weeks. Okay, this is when a seller tries to hang value on things the buyer didn't expect to see. But here's the real thing we have in play right now. Nor will they purchase a home that needs updating, because we're back into 90, 95% LTVs in a lot of cases, and they don't have the cash to complete the remodeling. Therefore, if the house needs too much remodeling, what do? I just go find the next one. This is flipping now really, really quickly to where sellers could just put it out there, and in 2021 and the first half of last year, didn't really matter what kind of condition we had. Now condition is paramount. And one of the other laws is law number 17, selling homes is all about competition. Yes, we have more inventory. Yes, we have properties sitting on the market, but we also have properties entering the market and being sold in very few days, still with multiple offers. Because the reality of real estate is this: either the marketplace is going to help you sell your new listing, or you're going to help someone else sell theirs. Positioning your listing is absolutely so important right now. And you have to be able to do this in the listing presentation, not after you get the property listed and you have market time. That plays into the other laws. We've got 27, 28 laws of how a marketplace works. We'll be covering the rest of those in 2 weeks. It'll really help you in your presentations if you'll enroll some of this dialogue into your listing and buyer presentations. Here's some first quarter action items for you. Due to the loudness of online and we've talked about this and talked about this and talked about this. You must double down. You guys, you have to double down on past client and sphere of influence systems in the first quarter of this year. If you take Bowen's numbers that, rates are going to stay, could be peaking perhaps, now is the time for you to double down and make sure your people stay your people. We have seen this run up in the marketplace of people going online to find a real estate agent versus contacting their own real estate agent that they dealt with before. I'm going to show you a model. I'm going to show you actually the case study of a client of mine and what they've been able to do by doubling down on past client systems. I can't overstate this case. So here's a quick little model that I want each of you to run on your own business. Take a number of people in your network, in your sphere of influence, your guys, however you want to frame that. How many people do you think that you have that are past clients and referral sources? Take that times 5. So if you have 100 people, times 5 is 500 potential referrals times 5%. And that will tell you how many transactions you should be doing by referral. This model lays out that 95% of the time we don't get the referral, or we get the referral and they decide not to take the job, or they had a relationship with another realtor, or they got referred to another, whatever. It's only a 5% conversion rate. Compare the results that you had in 2020 to this model. That will tell us how you're doing with your past clients. If the number of transactions that you did is less than what this model predicts, you have work to do. And I'll be honest with you, y'all know I travel around the country a lot. In any live, if you've ever heard me live talking to a group of real estate agents, I will always ask the same questions. And one of my questions that I ask is, if I'm one of your past clients or your referral sources, how often do I hear from you and in what manner? And I will start at the number 24. Raise your hand if I hear from you more than 24 times a year. And traveling all throughout the country over the last 8 years, I can tell you on one hand how many people, and this would be literally thousands of agents, have raised their hand at more than 24 times a year. All right? I'm going to show you the model, but this lets you know how you're doing with past clients. The number of people in your network times 5 times 5%. It was a theoretical model for me for a long time. It's not anymore, and I'll show you why. If your transaction number is less than the model, one of two things is in play, guys. And I could tell you this long story about my own personal business. I learned this from my own personal failings years ago. One of two things is in play. Number one, your database is too big. You got too many people in there, right? You got just everybody thrown into a database. You've got somebody that you had one cursory conversation with 3 years ago off of perhaps an online lead or a Zillow call. Or you're not contacting those people that you have in your database regularly and effectively. And those two kind of play hand in hand, right? Because once your database gets so large, you can't contact them regularly and effectively. And I will tell you this is what I'm talking to you about is not a real estate issue. It is a small business issue. I have had this conversation with people who own a spa. I've had this conversation with insurance agents. I've had this conversation with multiple people. We, as small business people, tend to spend disproportionate amounts of time, energy, and effort finding new people versus burrowing in with the people who already know us, like us, and want to deal with us. Here's why it matters. Statistically, 82% of sellers talk to one real estate agent. Okay, 82% of the people talk to one real estate agent when they're getting ready to list their house. 89% of sellers in a NAR survey said they would use their real estate agent again, but only 29% actually do. Now, here's why this is so important in this time right now. 78% of realtors do not make it 18 months. 83% of realtors are gone from the business in 5 years. The average person, Bo made the comment earlier, the average tenure for a mortgage is 7 years. The stat that I most recently heard was people live in their house an average of 9 years. All right. So if I live in my house for 9 years, 83% of the realtors don't make it 5 years. I can't call my realtor again because they're gone. And this is why you shoring up past client systems and making sure that you are the person that they recommend. Because if you look up here, 39% of the time they're referred by or is a friend, neighbor, or relative of the real estate agent. So the vast majority of the business is being done right here, guys. 68% of the time, right? It's a referral or I use the person before. So I want to show you what's possible if you put the right things in place. And again, this is the biggest action step for Q1. This is a case study with a team that I work with. The past client model that I will talk to you guys about involves touching your clients more than 24 times a year. Okay. Now that sounds like a lot. And people invariably go, oh my gosh, Wayne, I don't want to bug people. Well, what we're trying to do is get people to raise their hand to us that, hey, you're my person. And once I've raised my hand, they raise their hand to you, you're no longer being creepy by getting in front of them a lot. Okay. We take the same model that I laid out earlier, right? The number of people in the network times 5 people times 5%, that's the target number of closed transactions. This is a team that I work with of 17 people. They have a network of 975 people that they believe know them, like them, and want to deal with them. We take that number times 5, that's 4,875 potentials, times a 5% closed rate. That tells us that they should have done 243 transactions strictly by referral. Now, of that, the team leader had 165 of those 975 people. So that meant that they should have done 41 transactions, and he actually did 39. Team members had the remaining 810 people. That was 4,050 people times 5%. They should have done 202 transactions, and they actually did 191. This was an initiative that we went out on 2 years ago with this team. That could we maximize, were we maximizing the sphere of influence? The answer was we were doing pretty good, but we weren't maximizing it. And he put the things in place to help them do this. Total close from SOI last year, 230. That's a 94.7% efficiency on the model. Now, when you do the quick math that I laid out in the earlier slide, if you're at 94.7%, you're doing a great job with your people. But if you're not, which is where most people reside, this is why this is such a huge issue. We're going to see a lot of agents leave the business. Okay? It's going to happen. We're going to see a lot of agents leave the business. We're going to see a lot of people have to get ready to put their house on the market at some point in the future, and they're not going to call their agent because a lot of their agents aren't going to be in the business. And this is why you have the ability to really fortify and shore up this piece of your business before you worry about going out and doing anything else, right? Whether you worry about Zillow leads or Facebook plays or any of that. What are the drivers of this model? 4 client events a year. All right, 4 client events a year. And really the client events are just a vehicle to do the following. There's a video announcement sent out to everyone in this network, so that's one touch. There's a phone call follow-up inviting people to the event. That's touch number 2. There's an e-bike that goes out around the event. That's touch number 3. There's a postcard that also gets sent to their house. That's touch number 4. This is for every event. Then we have the event. Well, that's touch number 5. Then after the event, a video was sent out. That's touch number 6. And then there's a monthly postcard that goes out with just 12 touches. When you total all of this up, it's 36 touches a year. This is scalable. And I know a lot of you are followers of Brian Buffini, which I think is a wonderful program, and the pop buys. The challenge that people run into is there's a limit to the scalability of pop buys, right? If you have 300 people in your database that know you, like you, and want to deal with you, it would be quite a schedule to pop by 300 houses. So the event model is scalable. That's why I think this is very exciting. All right. And then here is, so again, as a group, they operated at like 94.7% efficiency on the projected number of transactions. There were some people in the group, this gentleman that I'm going to show you in particular, he was at 137% of the model. You've heard me talk about this, and I don't know how many of you have done it, but he did it. Create a closed Facebook group for your people, right? Here's Ryan Lerma's, he called it Lerma's Click, all right? It is a closed Facebook group for his database of people who know him, who like him, who want to deal with him. And again, he was at 137% of the model last year, dealing strictly by referral. Here's some of the things that he posts in there, right? So this is your way of connectivity with your people. You can just put out one post and it's going to hit your people. Join me in welcoming our newest members. And then he tells you a little story about the people and who they are and what they do. And then here, look, you see people saying, oh, this Carol Condit, welcome to the group, right? Here's the next thing that happened. Back in November, Cody Bruce said, does anybody have a recommendation to help me with Christmas lights? I'm getting a start on it myself, have no set of hands, you can read it. And then you hear people jumping in going, oh, well, Chris Compton's off. Well, I'd call Jose Hernandez. And then Ryan jumps in and said, this guy may be able to help you. Here's his number. Here's another person's number, right? Guys, this is huge. The people that I have been able to engage with that have actually pulled the trigger on this strategy, they're crushing past clients, okay? Again, the average for the office was 94.7%. Ryan was at 137%. What's the one piece of the puzzle that he's doing that some others weren't? It's this right here, okay? This is a huge issue heading into 2023. As I've said before to you guys, the third parties, the Zillows, the Ideal Agents, the OpCities, the HomeLights, the whoever, their whole business model is based on getting the consumer to contact them, not you. This is your line in the sand to me. You need to grow your database, right? So let's say you're like, well, I'm newer to the industry. I don't really have a database of people. I want to give you a little bit of a quick little strategy to try to leverage Facebook. Now, not by buying ads and sponsored content and all that. Let's get a little more granular with it. Identify the Facebook friends you have. What I discovered over the last couple of weeks in talking to agents, there was a disparity between the size of their network and their Facebook friends. They had like all these Facebook friends, but they only had a very small number in their network. And so somewhat on the fly, I came up with this strategy. Identify the Facebook friends you have that are not already in your sphere of influence, but who live in the area and could be referral sources. Now, they don't necessarily have to live in the area. You could do this with whoever you wanted to, but I think statistically your numbers are better if you focus on people who live in your area. Direct message the following message to these people. You're going to get copies of all these slides, guys, so don't worry about writing this down. Your broker host will have copies of this. They can send it out to you. Hi, blank. I was wondering if you have a realtor you would use or refer business to. If not, would you consider using me? It's a direct message. Here's why direct messaging is the key to this. If you've ever gotten a direct message on Facebook, you realize that as soon as you read it, the people know you've read it. And you feel this weird need to do something with it. You got to reply somehow, right? So why wouldn't we just ask our Facebook friends, hey, I was wondering if you have a realtor you would use or refer business to, and if you don't, would you consider using me? If they answer in the affirmative, then send them this one. Great. Could you send me your email address and home address? I have some great events coming up this year for my clients, and I want to make sure you get invited as well. Okay. So design an event-driven strategy for your people, and then reach out via Facebook and see how much information you can get. Because if they answer in the affirmative twice, they're going to be one of your people. And you then enroll them in whatever your process is, right? Whether that is the events, whether that is pop buys, whether that is, stock mailings and email, whatever it is, but enroll them in your process because they've raised their hand to you twice. We've seen bits and pieces of the chink in the armor over the last couple of years in agents follow-up and past client systems. The first time that we really saw a lot of it was when inventory numbers were so low, and we created the Blue Ocean letter for agents for y'all to send out into neighborhoods when there weren't any listings, but you had a buyer that wanted to live there. And the letter did get traction. There's no doubt about it. What was interesting was the seller always contacted the agent who sent the letter. They didn't feel the need to pull their other agent back into the transaction. That simply told me that the other agents weren't in flow with these people. So enroll them in your process. The goal is for you to become the hub of the wheel for all things real estate. I mean, there's Pete Grosso, if you all know Pocket Pete, he actually developed an app, or had an app developed, that he has. You go to his app as an agent. He's on Long Island in New York, and he has suppliers for all these various things. If you need a carpenter, if you need somebody to do carpet or clean your house or do this or do that, and he has all these suppliers listed. He's the hub of the wheel for all things real estate. Rather than you doing an app, I'm suggesting that you have a closed Facebook group where people can promote, just as you saw what happened organically in the post that I pulled out of Ryan's. And that way we always have top of mind awareness with people. Colin Coward said this: most people go through their whole life and they never get leverage, and that's sad. What's worse is when you have leverage and you don't use it. You've heard me read that quote to you I don't know how many times. Here's what I'm going to tell you guys today. Number one, you're here. You aren't going anywhere. You're not going to be part of the 17,000 that left the industry last month. You've got leverage. If you're on here, I know you do a great job. I know we talk about the mirror test all the time. I know y'all are good at what you do. You have leverage. You have to use it though. And your number one leverage point to maximize is going to be these past client systems. And I would tell you, do an event first quarter of this year so that you're back in front of your people, even though we know rates, according to Bowen, are not going to be dropping, but it's going to allow you to have a very high level conversation with your people now so that you position yourself when the marketplace turns, rather than trying to chase people when the marketplace turns. You're here, you have leverage. Use the leverage points that you have. Warren Buffett said, be fearful when others are greedy, and be greedy when others are fearful. Right now is the time for us to be greedy, put the systems in place, get the materials lined out, so that when this marketplace turns, as we know it will, because Bo showed you the stats, that you're the person that your people are going to call. Oh, I don't know why that's in there again. Sorry. So bottom line is, let's get after it. We are always here to help you. You can go to WayneFrederick.com and download materials. My email address, my cell phone. You guys want to text me? More than willing to take the reply to you. You can call me, whatever. If you need other things, you can reach out to Madeline. That's admin@stfconsult.com. Guys, we are here to help you in 2023, help you navigate through this in harmony with your brokers. I just thank you so much for taking an hour out of your day on a Wednesday at the beginning of the year. I hope you found value in what we talk about. And here's the schedule for the next year, just to let you know, every other week, basically, other than if I happen to be traveling or something like that. And with that, I will open it up for whatever questions y'all have. So if you want to raise your hand, or type in a question, and Maddie will navigate the questions, and Bowen and I will do our best to answer whatever questions you have.
Like Wayne said, if you have a question you'd like to ask it yourself, feel free to raise your hand and I'll unmute you and you can ask them your question, or you're welcome to send it in the chat or Q&A and I'd be happy to read it for you.
Like we have a question, Madeline.
It is a thank you.
Yeah, so you get to see the same thing I see, huh?
We just have some positive affirmations here of that it was great information from the two of you, and let's get to work. All right, Mary Black, it looks like you've got your hand raised. I'll go ahead and give you permission to speak if you'd like to unmute yourself.
Hi, yes, and thank you for having us. And it was a lot of really good information. I'm curious about the events. Like, what would that look like? So do you invite a bunch of people to a club, and like, what do you do at the club? Is it heavy appetizers at lunch, or how do you
Okay.
like, what do I do?
Yeah, in the particular case of this group, okay, so they have 4 events a year. All right. They have one big event that they call Paint and Pour. Okay. The team leader's wife is an artist. So what she does is she sits down with an easel, and everybody has their own easel and paints, and she paints a picture and you try to paint it too. And the reason it's called Paint and Pour is it's beer and wine is served. It lasts about 2 hours. And basically what the team members do is they don't paint, they just, talk to their people while the people are trying to paint the picture. Okay. To give you an idea, they started it 4 years ago. They had 20 people show up. Last year they had 250.
Oh my God.
So that's their big event. It's the only event, and I think you need one of these events a year that has a start time and a stop time, right? Where people come and attend, it's not come and go. The other event that they do is last year they brought in an ice cream truck into their parking lot. They sent it out to everybody. It was like the week that they knew everybody would be taking their kids out to buy school supplies. They invited people to come by the office and get an ice cream cone or a snow cone or whatever it was, right? Also at Paint and Pour. Now this, for some of you, you're like, I would never do that. They gave away a trip voucher at Paint and Pour. One of the attendees won a $3,000 trip voucher. And she came to the next event and was just singing the praises of this team to everybody who would listen. The other event that they do is they do the pie thing like so many people do. They do pies, and then they do a Santa Claus picture picture with Santa, because that's something that kind of has gone by the wayside now through the pandemic and all things like that. So that's their 4 events. I think the key is, and if Brian's on here, he can speak to this. I think the key is that you have one of those events where it's not come and go, it's not stop by, it's actually there so you can talk to the people and fortify the relationships. So that's their 4 events, just to kind of get your mind reeling.
Cool. Thank you.
Okay. Thank you, Mary.
Thanks, Mary. Before I give you permission to speak, Jennifer, we've got a couple questions in the Q&A. They'd like to know what percentage of your yearly budget should go toward marketing. They've heard anywhere from 10 to 30%. What do you all think?
So I was modeling out with a client yesterday, and at some point I'll probably share all of the details with you, but I would target $40 per year per person. That's where this model tended to settle out. Okay, $40 per person per year, and you should be able to do the events and the mailers and the contacts. So if you had 100 people, that would tell you it'd be $4,000 that you spend on past clients.
Yeah, Wayne, my answer to that was going to be somewhat similar. It's really not so much of a percentage of income. It's more so a dollar amount based on the type of marketing you want to do. And also,
Yeah.
I recommend if you're not already working with a CPA as far as business expenses, because you might have more wiggle room than you think, depending on your income, what you can write off as an expense. So I would say I would look at it from a dollar perspective, not a percentage perspective necessarily.
Right. The models that we were running through yesterday ended up right at $40, $40 per person in your database would be a good target number to go with.
Great. All right,
Next question, Maddie.
Jennifer, if you would like to ask your question, you're welcome to unmute.
Okay, I think I'm unmuted. Hi, it's actually not a question, but I wanted to just offer up an idea for Q1 that I have done before from a brokerage level, but I have a lot of agents that do this that I think is huge. And Girl Scout cookies are huge, right? So I know I got contacted by my local Girl Scout dealers that the cookies are coming in our area in Florida, I think January 10th. And so this is a huge, it's more of a pop buy, but you could certainly do some type of event around having them come to you and pick them up if you don't want to go do pop buys. But there's so many great ideas. If you go on Pinterest or just Google up pop buy labels, there's so many good ones out there for, if you want to make a mint in real estate, you could do the thin mints, or I would love Samoa, your referrals, and use the Samoa cookies. There's so many great ideas out there that it would just be an easy, and the spend on that, they're $5 a box. You could do a coffees and cookies event at a local coffee shop and invite all your customers to come and give them their Girl Scout cookies with a little label from your team. I mean, that's just an easy peasy lemon squeezy idea for some of you that are struggling with a Q1 idea.
Very nice. Thank you for that.
Awesome.
That's awesome. Yeah, look, guys, the key to this thing is that the one thing we've learned, or I've learned over the years on this, is it doesn't matter how you're contacting people, just so that you're doing it regularly and you're doing it in not exactly the same way every time. So I would tell you that 36 emails a year, it's not going to cut it. 36 postcards a year, probably not going to cut it. Get it to where you're hitting them in various ways, whether it's events, whether it's direct contacts and things like that. What we don't want to have happen, and I had this conversation with somebody yesterday, and they told me that, if I had to bet on the one client that I had that would never use anybody but me, and he was on a walk and he walked by their house and they had it listed with somebody else. And he called them and asked, had he done something wrong? And they said, no, we just, we kind of stumbled into this deal, and before we knew it, we had bought the house and we put ours on the market. So we're salespeople. And one of the things I want y'all to realize is we always deem these relationships to be deeper than the client does. And we got to spend our time, energy, and effort fortifying it with the people we have. Let it grow organically. If you're the one thing we determined in the team that I laid out in the model, this thing will grow at a rate somewhere between 30 and 33% a year if you're doing the right things. So you can kind of forecast where you would be 5 years from now, and what the budgeting would have to be and things like that for some long-term planning. But Jennifer, thank you for the comments. I really appreciate it. Any other questions?
Yes, we have a question from the Ryan Kramer Watch Party. I love that you changed your name on here, Ryan. Bethany would like to know, when do you kick a client out of a database that is not responding or for other reasons?
Probably not going to like my answer. I kick them out really early, but I lived on the other side of this equation, where I had 1,450 people in my database that I contacted very sporadically. If you're hesitant about eliminating someone, what I would suggest you do, or my rule would be, you got to call them. And you have to keep calling them until you get a hold of them. And you have to ask them the questions of, can I have your email address? Can I have your home address if you don't already have it? And I've always said, if you're unwilling to call them, you really kind of have to look in the mirror and go, is this really one of my people? If I'm hesitant to call them. So I'm a huge fan of smaller databases of people. but more vibrant databases. I never bought into the A, B, and C thing. You got your A's and your B's and your C's. In my world, it's like you're either an A or you're out, right? Because I want to count you as a referral source. I want this to be a special deal. Now, I will tell you that on Brian Woodward's team that I used as an example today, their rule is, and they're enrolled in the Buffini program, and Buffini has what they call the mayor campaign. And if you haven't done the mayor campaign, which is basically the question that I put in there that I want you to DM your Facebook friends, if you haven't done the mayor campaign on people, you can't put them into the system. They want to know that there's at least that somewhat level of commitment. So if I can draw the line and decide I can't get that level of commitment, I'm eliminating the people from my database, because I want to take that $40 that I might have spent on them, and I want to, spread that out over the people I have, or go find me someone else that would be one of my people. That's my take on it. Any other questions?
Going once, going twice.
None
Nope,
of them.
got one in here. Let's see. Will buyers be paying the agent that represents them? This is about the NAR lawsuit slide. They said they joined a little bit late to the session today. Will buyers be
It will
paying?
have to be, yeah, it'll have to be factored into the transaction. Bowen, I'm gonna yield to you. My understanding on this is, with the exception of government loans, a buyer's agent fee is an acceptable closing cost for a seller to pay. Is that correct?
Yeah, I believe so. Yep.
So yes, the buyer will be what we're going to see happen, if depending on how this thing goes through the courts, right? We're going to see that the buyer is going to be responsible for paying the fee, but it's probably going to be now called a closing cost that they're going to ask the seller to pay. Is it the same thing as where we are? Yeah, pretty much, but there's a lawsuit. It's a class action deal. And something's going to change, going to come out of this. And we just don't know what. I'll just keep you apprised of it. Rich, you have a question?
Rich actually is the person who had this question. So
Yeah,
Rich, is there
sorry.
anything that you'd like to elaborate?
No, I've been hearing so much about it. I just don't know how that's gonna work. Well, when the seller pays their agent and the buyer pays their agent, is it a flat fee? Do you do a percentage? Is that gonna be regulated or anything like that? And you said it'll probably be on government loans? Is that what you said, Wayne?
As of right now, my understanding is it is an acceptable buyer closing cost unless it's a government loan, and they haven't said it's an acceptable closing cost yet. Rich, it's going to be, honest to goodness, it's going to be whatever someone can negotiate, just like a listing fee.
Gotcha.
Right?
Yeah.
And whether this thing is gonna, I didn't really personally, I didn't hear a lot of people complaining about the way we've always done things. Sometimes I wonder if it wasn't a fire truck going around looking for a fire and they couldn't find a fire, so they built a fire. It was granted class action status in the state of Missouri where I live. We're apparently a very, one of the lawsuits in Missouri, one I think is in either Illinois or Indiana. We're apparently a very class action friendly state.
Is it true?
So I will keep you apprised. I do think this. We've had buyer agency for 20 plus years. And virtually, I think every state actually has a state law that says you can't work with a buyer unless you have an agreement. Or you can't work with a seller unless you have a listing agreement. But every state also turns around and lets you work with a buyer all day long without an agreement. And I think that's probably going to change. You're going to have the ability to get a buyer agency signed before you show property rather than right before you write the contract. I think that's what the switch is going to be. So I'll keep you apprised. And again, we have a session coming out on it. We did it last year. We'll do it again on the value that you can bring to the table for a buyer. Any more questions, Madeline?
I think that's it.
All right. Guys, thank you very much. Thanks for hanging in with us. Appreciate you. And we'll see you in 2 weeks with the next session. Bowen, thank you so much.
Hey, thank you for having me. I really appreciate it.
The kickoff 2023 Wednesdays with Wayne. Thank you all. Appreciate you. Have a good day. Bye-bye.